Welcome. Thank you everybody for joining us on our first, just so you're not aware, this is our first webinar. We are the Valorous Capital Partners. My name is Jeff. I'm your co-host. We got Ritesh and Claudio on as well. I'll let them get to their quick intros after that. But before we get started, folks, this is what we're going to call the Unleash Your Investment Potential with Multifamily Properties. So we are very, very excited to bring this to you guys. And this has been a long time in the making. And we're very excited to kind of show you guys what we got here. So before we get into it though, right, I got to show you this disclaimer, right? This is something that you have to see, right? So basically, let me talk about the strategies that are mentioned in this presentation or may not be appropriate for everybody, right? If you want to read through it, you can too, but basically we are not financial providers. We are not giving you legal advice. We are not tax consultants. If you have any questions or concerns or anything about that, please contact your CPA. Please contact your tax professionals and attorneys. There you go. You've been disclaimed. There it is. All right. So who is Valorous Capital Partners? So I'll start off real quick. My name is Jeff Hervik. Most of you might know me. Some of you don't know. By trade, I run a small woman-owned business for cloud and technology consulting, but I've been actively investing in real estate for the last couple of years, since 2017. I currently own a portfolio of single-family rentals. I own short-term rentals. I've done private lending. I've done hard money lending. Shout out to my buddy Sean over there. I actually am also a limited partner in multiple apartment complexes currently right now, about 360 doors total, worth about 46 million. Now I'm not worth 46 million, but the deals we're invested in, the apartments are valued at 46 million. I own a piece of those. So from there, I'll pass it off to Ritesh. Ritesh, why don't you go ahead and do a quick little intro?
Yeah, absolutely, Jeff. I love the energy and thank you for kicking us off. So first and foremost, I want to say thank you to all of you. I mean, this turnout is awesome. And, we just really hope that we provide some value in today's webinar. So as Jeff mentioned, my name is Ritesh Patel. I'm a managing partner here at Valorous. By trade, I'm actually an emergency medicine physician associate. Been doing that for the last 6 years. But, early in my career, I understood the importance of investing. And, to get the future, I always envisioned for myself, my family, future generations. I knew that investing was important. So I began investing in commercial real estate in about 2018. The benefits. And this is something that I just became truly passionate about and just helping others as well in this field as well. So I do bring in some experience of owning and operating hotels as well as general partnership experience within commercial multifamily properties. And like I said before, I just really hope that we provide some value to you all today. And I'd like to pass this off to Claudio.
Awesome. Thank you very much. I really like the energy. So definitely trying to get used to being on East Coast time again. My name is Claudio Sanchez. I'm one of the managing partners here. Have been doing real estate for about 7 years, started in single family, like a lot of you guys probably, and just like Ritesh and Jeff also. And then move on to multifamily. So right now I have a portfolio about 1,200 doors. Some of them are I'm a limited partner. Some of them I'm a general partner in them. And yeah, looking forward to provide a lot of value and make you guys aware of all the great opportunities that we have going. Nice. And all the benefits.
Nice, excellent. So you guys, that's the team right there. Don't forget Robin Sanchez as well, Claudio.
She couldn't be with us tonight. Yeah, she's we just got back from a whole month in Europe. So she's out taking care of the family while we're here holding down the fort.
Excellent. Excellent. So let's get into it. Ritesh, tell us a little more about Valorous Capital Partners.
Sure. So Valorous Capital Partners, basically, we're a private real estate. So we specialize in commercial multifamily property acquisitions as well as asset management. And through time, we've just built awesome, relationships with experienced operators. Some who've been in the industry for well over 20, 30 years. These are people with proven track records of successfully implementing, the value add business plan, which we'll get into in a little bit. And then they've also had multiple exits. But really and truly at our core, our mission is to provide value to you as well as everyone we work with.
That's right, guys. And I forgot to mention earlier, but if you have any questions, please drop them in the Q&A button. If you've got any questions, if you want to just say hi to people, drop in the chat. We'll have people monitoring both the Q&A and the chat. We'll have some breaks for talking to listen to some answers and questions as well too. All right, so tell us about a little portfolio here.
Yep.
Ritesh.
So basically, you're going to see a bunch of pictures of apartment complexes here. These are actual examples of properties within our portfolio currently. And so you can see we invest in properties that are class, B or C multifamily properties. So preferably we like to have 100 units and up, which we said so is a B type or C type, which we'll get into more in a little bit. But we like to have these in areas that are B or A, so in nicer areas. So we want poorly managed, poorly operating properties that we can come in and add value to them, in a really nice area to ultimately, appreciate these properties over time.
That's right. That's right. Love it. Love it. So guys, we're here to show you why the Valorous Capital Partners, why we're so excited about multifamily real estate and what the benefits are for investing within multifamily real estate. So one of the best things to kind of show you, this is kind of going to be the little outline, right, of our presentation. We're going to talk a little bit about the recession, inflation, resiliency of multifamily properties, the stability, diversification, what that means within real estate as well, how far you can diversify within our portfolio of even multifamily properties, what kind of cash flow you can receive from investing in properties. One of our most favorite terms right there, right in the middle, smack dab in the middle, shows you it's called forced appreciation, right? What is forced appreciation and how does it affect it, the purchase of the property? And another favorite for all high net worth earners out there and people who want to write off as much taxes as possible, there are some great tax benefits too. It's going to be exciting. You can't tell, I'm pumped up. Are you guys pumped up? Tell me if you're pumped up in the chat. If you're pumped up, write a yeah. Write a yeah in the chat. I don't care how you spell it. Just write a yeah in the chat if you're pumped up.
And what you're pumped up about.
Exactly. Maybe what you're pumped up about. Yeah, there you go. Pat Dotson's pumped. That's what I'm talking about, Pat. Yeah, him and I worked out this morning, CrossFit. So I know you're pumped up. All right. So excellent. So let me go ahead and talk a little more about the recession and inflation resiliency, right? So what does this mean for multifamily investing, right? So if you look at the first button right there, so during a recession or during down markets, right? It's been proven over time, even there's documents out there's stuff that show you over a 20-year period, right? Or even since the 1930s, a multifamily property has been the best and most stable asset when it comes down to investment in any downturn type of markets, or even in an upturn market as well too, right? Unlike the stocks and mutual funds that are tied to indexes or tied to the market that can fluctuate up and down in recession, we saw what happened in COVID in 2020. The markets just dropped and tanked, right? And then it sprung back up again, and then it hit back again down in 2022, and it came back as a roller coaster ride, right? So in this real estate market, right, real estate is very resilient to that recession and resilient to that. Now, inflationary markets, same thing. So when we've seen it today, right, where inflation will increase, right, the cost of living, right? So if there's something called eggs and milk, right, and gas, right, all that stuff is going up in an inflationary market. Well, your money, if it's sitting in a savings account or sitting in your checking account, well, that money is losing value every single day. Every single day it loses value. If you put it into an investment like a multifamily property, that is going to have a steady incline because we all know the assets will always increase in value. And what it also does to interest rates, right? We've all seen as well, the current interest rate, I checked it this morning, 7.13% for a 30-year fixed interest. I don't know about you, but I haven't seen that since my parents bought a house in 1980, right? So it's driving interest rates up, right? And that drives people into moving into apartments, right? So they can't afford to buy a house, or they don't want to afford, they want to sit in the sidelines a little bit and wait a little bit until that market kind of corrects. Well, they're going to have to rent someplace, and why not better than in a great apartment complex from us, right? And even home prices rise. You'll see the pressure on that, and then that will steadily put people back into apartment complexes. So in that mode, recession, inflation, resiliency is one of the key factors here, right? And let's talk about some stability, right? So when you've got a hard asset, like a piece of property on a land, right? And if it's taken care of very well, which is what our team does, that product is not going to go down in value, right? It's going to appreciate and it's going to go up when stocks and bonds and all that kind of stuff can go down. And what we also see is that it's, housing is a basic human need, right? I guess you need three things. I read Ritesh and I were talking the other day, right? Ritesh, we need shelter, food, and water, right? And maybe, warm body next year, right? But anyway, you need shelter, food, and water, right? And so what that does is that it creates an environment where we can provide that shelter, right? That's the market we're in. We can provide a shelter, and I'm talking about a really good shelter too. I'm not talking about your Section 8 properties or your junky apartment complexes that some of your friends might have lived in. I'm talking about really good, really nice assets, and that's what we provide, is that basic human need. Ritesh, you want to talk about some diversification?
Yeah, sure. So great info there about stability. So many can agree that, having a diversified portfolio is important. I mean, you can invest in stocks, bonds, mutual funds, real estate, but even within these categories, you can achieve diversification. So you can invest in tech stocks, for example, or travel, tourism, whatever it may be. So let's talk about how you can achieve diversification within commercial multifamily. First thing you see there is income streams. Really, it's like tenant diversification. So apartment complexes, typically with multiple units like the ones that we invest in, they're typically occupied by a diverse pool of tenants. And these are tenants with different demographics, different income levels. But overall, what this does, it helps mitigate the impact of vacancies whenever there is an economic downturn. For instance, if one tenant segment is affected during inflationary periods, it's likely that in a 100-unit apartment complex, there's several others that remain unaffected. And what does this do? It helps us maintain steady rental income. So there's diversification there. So the next thing you see here is geographic diversification. So investors can also achieve diversification by investing in different areas of the United States. For example, let's say you want to invest in a property in Florida. Great. If anything happens in South Florida, whatever it may be, we're going to have opportunities as well in Northwest Arkansas, for example. These are different geographic locations that diversify where you want to, invest in. Next thing we talk about is property type. We're going to get into this a little bit deeper in the next few slides, but essentially, you can invest in varying, property types, varying sizes. For example, we talked about before, Class A, Class B, Class C. Well, typically, just want to keep Class A already stabilized property. It's usually newer. It's already achieving market rents, so it may cash flow quicker versus a Class B or C, which is going to require a little bit more stabilization, but typically bigger upside. So depends on how risky you want to be, how, just it all depends. But you have options, and you have options to diversify your portfolio.
Love it. I love it.
Let's go next here. So we have cash flow. Cash flow is important. We all love cash flow. So what you're going to see here is the cash flow equals income minus operating expenses minus your mortgage payment. So typically a well-managed property, and what we mean by that is typically properties that have, institutional property management, someone who's running it effectively. We're generating market rents. It's stabilized. We have good occupancy. We're going to have cash flow, and the cash flow ultimately increases the NOI of the property, the net operating income. And that overall increases the value of the property. So, we ways, not just from the rent roll to get this cash flow up, right? So we're going to look at, things like reserved and covered parking, for example, vending machines, laundry units, storage units even. But stable cash flow also allows us, not only to pay our operating expenses, our debt service, but really importantly, our investors. And so that's what we're in the game of.
Yeah, I love it. And who doesn't love getting cash flow and getting passive income, right? So we'll talk more about passive income here later. I do too, right? So why not? All right. So I touched on this earlier, right? One of the most exciting parts about multifamily properties is the power of forced appreciation. We all know what appreciation, right, is the value of a piece of an asset going up in price over a time period, right? Well, what we do is we take that and we actually force it to appreciate. We take that property and we do stuff that makes it more valuable faster, right, than just the length of time that we own that property, right? So one of the best ways to do this is through your net operating income, right? And so by increasing what Ritesh mentioned earlier, by increasing your net operating income, right, which is your total income minus your operating expenses, that piece of property or that value of that property will increase. And I'm not just talking by a few $1,000s. I'm talking about millions of dollars. That piece of property will increase in value by millions. It is proven time and time again when you buy value add type multifamily properties and you put these strategic improvements into it, you're going to increase your net operating income and you're going to increase that value. Now, it's not just about increasing or putting those strategic improvements in place, right? It's about increasing the rent to market rents, right? Or if you have a top dollar piece of property in that area, maybe you can get a little bit more, right? And you can drive that into that. But it's also about reducing your operating expenses. And that's something we're going to talk about here in a little bit as well too. So what are the value add opportunities that we can do, right, for these properties? What we do is we take the property, right, like Ritesh mentioned earlier, we're going to buy a property that's either mom and pop managed, right, under mismanaged or not managed at all. They haven't really paid attention to the maintenance queue. The maintenance is building up. The tenants are unhappy. You know, no one wants to live in there. So they kind of word of mouth gets out and they can only really charge low rent in order to get people in there, which obviously is not a good recipe. It's a recipe for disaster, basically. So what we're going to do is we're going to buy a property like that, right? That's the key. I love when people have those properties because we're going to buy those properties, right? And what we're going to do is we're going to renovate all of the units, right? So we're going to take those units from what's considered like a C class unit and we're going to make it a B class unit, right? Whether that's putting granite countertops in, new vinyl plank floorings, right? We're going to maybe paint the cabinets or replace the cabinets altogether. Depends on obviously the situation of the property. We're going to add new appliances. And again, depends on the market, right? We're not just going to throw quartz countertops and stainless steel appliances in a property that might not need that, right? Maybe it just needs nice brand new appliances, white or black, right? Something like that. And a nice granite countertop, right? And that will make it real nice, right? So we'll increase the value of that property, increase the person's living home. If they can live in a much cleaner, nicer area, people are going to pay more money to live there, right? We're also going to enhance the property, right? So what we're also going to do is going to say, let's say the building needs to be painted, right? Or it needs to be updated in the exterior, or it's old exterior. We need to make it look nice, make that curb appeal do well, right? Have you seen all those HGTV things do curb appeal for adding new landscaping, right? And those are like the key factors. We're going to make it look nice inside and outside, right? And then we're going to add some fun stuff, right? We're going to add things like playgrounds, barbecue areas, gathering spaces. Car washes are key. And I think one of the most unwritten or one of the most underrated things is delivery package receiving areas. That's a huge thing that a lot of people, because I don't want my packages stolen on my doorstep, right? Or left in a garden style apartment. Sometimes they're on the outside, right? People can see that. So we create an opportunity where there is a secure delivery for those UPS drivers or for the FedEx or Amazon drivers to get those packages, where the tenant can go in there and securely gather packages, right? Those things, remote office spaces, all those things can add into creating and enhancing the value of the property. Claudia, you want to add anything? What do you think?
Yeah, so in some places, something as simple as valet trash, right? Which is the concept that somebody comes to your door and picks up the trash and takes it to the dumpster instead of you.
Yeah,
That's adding value. That's a really easy way to add value. And it increases the net operating income, which then forces the appreciation. So if you have 100 apartments and about 50 of them pay you $10, right there, right? You're talking about getting a chunk of money that you didn't get before, virtually by just walking their trash over to the dumpster.
exactly.
And therefore, you're increasing the value of the property.
Yeah. And so we got all these other additional streams of income that we can add to beef up our net operating income, right? So we can do things like what's called RUBS. So RUBS is taking the billing for the entire unit, right? Because typically those units are billed at a whole, right? So we take that unit and we, instead of the owners paying for that and then charging a flat rate service to each of the tenants, we take that back and we put it into the tenant's pocket, right? So we say, hey, tenant, you used $100 worth of electricity, you're paying $100 electricity. You other tenant, you've only used 50, you're only paying 50. So we take it off of our plate and we put it back in their plate, and that drops our operating expenses, right? Drops the expense of the property. We can add things like laundry units, vending machines, and we can even have companies come in and do that for us. So we don't even have to manage it. They manage their own machines and we get a cut off their machine and they make some money too, right? So it's a win-win for small business in that area, and it's a win for us as well too. And the people, the tenants, they love to have laundry on a unit, or even better, have a laundry in a unit. If I can do my laundry and then I forget to, take it out of the dryer overnight, oh well. But if you forget in a laundromat, that might be an issue, right? We charge extra for pet fees. I know a couple of my properties that I have, my amazing property managers who are on this call as well. Shout out Pat Dotson, right? They charge pet fees and we get extra income because of that, right? Reserved or covered parking. Who wouldn't love to have a parking space right in front of your unit? I don't know. I would love to have that. Can I pay an extra $20 for that a month? Sure. I just won't buy that extra 6-pack, right? Yeah, let's do that, right? So I'm going to go ahead and pay an extra $20 so I can park right in front of my unit. Easy. And you have 100 units times $20 times 12 months. That's a lot of money extra for doing nothing, right? And storage units, the same thing. We can add storage units and we can charge for those storage units because sometimes that space is valued or it's premium. And I remember when I lived in an apartment, they didn't charge for the storage unit and we had a dusty old nasty one. Well, what if you came in and you revamped that, put some nice lighting, painted the doors, painted the walls, and you charge an extra $100 a unit for those storage units? Well, 100 units times 100, again, money adds up, right? So all those additional revenues and streams of revenue can add to the value of the property. And again, increase it. Let me go back to that slide so you guys can just let this sink in a little bit. It can increase by millions of dollars, right? Not just thousands. And we've got proven track record to show you that as well too. Ritesh, why don't you tell us a little more about some tax benefits that we can take care of?
Yeah, this is an exciting topic. A lot of my investors are typically physicians and high worth earners, and this is what excites them a lot. And it excites, I think, everyone, because really and truly, who wants to pay taxes? And this is where I have to remind everybody that I'm not a tax strategist, I'm not a tax advisor, and everyone's situation is different. So please consult your own professionals here. But in commercial, to depreciate the building and its contents over 27.5 years by something called straight line method, which is great. But we actually hire professionals to come out and do something called a cost segregation study. And what is this? It's a strategic tax planning tool. It's used in real estate to help accelerate depreciation deductions and overall reduce our tax liability. So what do we do? Basically, this study determines the depreciable of the building plus the contents, such as flooring, plumbing, light fixtures, exterior enhancements that we've done. We talked about, the value add strategy a lot. So these are exterior enhancements that we do to the curb appeal, for example. And overall, instead of 27.5 years, we're able to take a lot of this depreciation within the first year by something called bonus depreciation. I think in 2023, it's now 80%. But hopefully there's going to be some laws passed that, we can get it back to 100% like how it used to be. But regardless, 80% is still very, very great. So, yeah.
Awesome. Definitely for those high income earner individuals, this is very advantageous.
Yep, exactly. Sorry, I was on mute for a second, but I love the K1 at the end of the year. Basically, if I can get a paper loss while I'm earning cash flow, who doesn't love that, right? I mean, that is amazing.
Yeah. And I forgot to mention all of our passive investors will get a K1 at the end of the year, and you get to benefit from these deductions as well. So
that's right. All right, so we're going to take a quick break, talk about some questions. I think we had some questions pop in. Looks like Claudio. Well, we actually, I see Ben asked a question about what's your process of finding a good deal to purchase. We will get there, right? We will answer that question in the next portion. So Ben, hang tight on that question. Any other questions out there, guys? You see any questions in that chat box there?
Let me see. Not on the question side. Let me see if there is anything on the chat. Not at the moment. So let's continue.
Gotcha. Okay. Awesome. Well, appreciate it. Right. So
there's one that just popped up in the Q&A.
So basically this one is asking, would investing passively affect personal credit if anything happens to the property? Take this one, guys, if you want. So, I mean, it's a great question. We spend a lot of time and resources on our underwriting process to ensure that we're really never in a position for foreclosure, but it's a great question and it's valid. As a passive investor, your personal credit is not required to sign on the loan. So it wouldn't affect your personal credit if we went, and for whatever reason had a foreclosure or bankruptcy. And it doesn't affect your ability to go and buy a car or a house. So that's it. We have a deal sponsor usually. Usually the deal sponsor has a net worth equal to the amount of the loan. The collateral is the property in this situation. So we'll get into this a little bit later, but good question.
Yeah, excellent question. Excellent question.
Yeah.
All right, so let's get into it. As far as what is passive investments, Marino? Why is multifamily investment? Why is it a truly passive for the partnership, right? So when you look at a passive investment, what is that? There's actually a guy that I follow on LinkedIn. Maybe you guys should go check him out too. His name is Justin Donald. He is the king of passive investments and understanding it. And he says that we should do 60% of our portfolio into real estate of some sort that can get us passive income. 25% usually into stocks and bonds and in that market, but 60% of it. So I was looking at that. I'm like, that actually makes sense, because if I can get 60% of my portfolio generating passive income, that'd be amazing, right? And so it's a limited time investment. That first box right there. So as a passive investor, you don't really have anything to do except for put up your capital. Once you put up your capital, that money goes to work, and we actually go to work for you, right? We take that money, our asset managers, who we'll get to in a minute, and our property manager will get to in a minute, they will go in and they will do that forced appreciation value add strategy and create that opportunity so you don't have to lift a finger, right? It's a hands-off approach, right? So our property managers, right? They're institutional level property managers. What does that mean? It means that they oversee thousands of doors, right? And those thousands of doors give them a process where they can very much come in and run 100 unit and run that thing tip-top shape, get the right people in the place, have an on-site maintenance guy as well, or maintenance person, right? That can handle all those issues, right? So as a passive investor, you don't have to handle the tenants. That's a great one. You don't have to handle any trash, which is another one. You don't have to do anything about the toilets, right? So you don't have to worry about that. That's why we benefit from the profession.
Nobody calls you at night telling you that there is a problem with the water supply.
That's why exactly. Yeah. No, you don't want to go. Who wants to be called in the middle of the night for that, right? That's why we hire property managers, right? It also reduces your risk exposure, right? So instead of having it based on one property, right, and that one single person not paying that unit, it multiplies it over, let's call it 100 units, right? So if we're doing 100 unit property, in fact, you saw our thing earlier in the presentation, most of our properties are 130 plus, right? We got some 336 units. So if that one property loses 1, 2, 3, or 4 people, you're losing 1% of 100 person. That's not a lot of money, right? You can easily take care of that. And as we just mentioned with that question that was asked by one of our participants, limited liability. You don't have any liability. You're the only thing that's at risk is your capital, right? Yes, we understand your capital is very expensive and very valuable. You like to hold on to that, right? But it's the only thing that's at risk, right? There is no legal issues beyond anything that's going to show you any issue. The best part about being a passive investor, or what passive really means, is you can sit back and get money in your account every quarter, right? You can earn cash flow, like Ritesh talked about earlier, with these investments in your mailbox or in your bank account, direct deposit it every quarter. You could sit back and let it grow, right? And that's the beauty about it. So here, Ben, you asked about our deal process, right? Or how do we find good deals, right? And so, Ritesh, why don't you give us a good overview of the deal process?
Yeah, so this is important. I mean, this is how it all gets started. So, at Valoris, we basically have a very rigorous process of vetting good deals. We like to say we don't just invest in any deal. It has to definitely be the right deal. And I mean, this means underwriting hundreds of deals, in a month to maybe not even find one good deal that works. I mean, that's just the name of the game. So the point is to not get emotional about, any deal that comes across our desk. It has to hit our criteria. So let's talk about, what this process looks like. So the first thing that we're going to do at a market. So we're going to select and analyze what market we want to be in. After we've done that, the next step is to find the right property within that market. We're going to get into the details of these a little bit more, but the next step is to make an offer, negotiate, and then obtain financing. So negotiation is huge here. So basically, you know, at this point, you know, you don't just jump into any deal. You have to negotiate. You go back and forth between the seller, the broker, and you want to agree upon a deal that actually works for both parties, right? And then same thing with obtaining financing. Is we're gonna reach out to multiple lenders, get multiple quotes, you know, and compare it. So the next process of this is our inspection and due diligence period. What this means is that, you know, once we're under contract, we're actually going to go in and inspect the property. We have a team along with us. We're going to actually travel to the property and we're going to look at the roofs, the boilers, the chillers, whatever it may be. I mean, we're going to inspect the property, you know, from A to Z. Yeah. And if we find anything that doesn't add up, something that just wasn't disclosed to us by the seller, well, we're going to renegotiate. And the renegotiation process is usually either a lower purchase price or, you know, these things need to be corrected before we buy the property, right? So, and then the next thing is managing and improving the asset, which we'll get into. This is called asset management as well. And then lastly, the exit strategy. The exit strategy is something we think of from the beginning. This isn't at the end. This is something that we've already thought of. You know, this is something that we think of when choosing the debt structure. So that's going to be part of the deal process as well. So let's go ahead and go next here.
Yeah. Hey, I want to add one thing on the due diligence. So our team actually goes out to the property when it's under contract and they inspect not just a handful or a subset of the units that are there, however many units are there, they're going to walk through every single one of those units and inspect it to make sure that the information we receive from the seller is accurate, right? Or that we know, hey, we've got now, you know, 50 units that have a light rehab and 100 or 50 units that have a heavier one, right? Or vice versa, or whatever it might be.
Yeah. So the first thing is in this whole process is, first of all, choosing a market. So you might be asking, you know, how do you even choose a market during inflationary periods, right? Well, I mean, to mitigate the risk of economic ups and downs and things of that nature, we only want to invest in what we call growth markets. So growth markets are typically on the right side of the equation during inflationary periods, because they're simply less impacted compared to non-growth markets during downturns. So some of the things we look at is year over year rent growth. So we look at markets with a history of steady rent increases. The next thing we look at is employment growth. So we want to see that, you know, an area with more jobs, right? More job opportunities ultimately lead to increased population, which ultimately leads to more demand for housing, right? And then more jobs means we should see less unemployment. And then we want to see a higher percentage of renters versus homeowners as well. That's important to look at. Another statistic we look at is population growth. So population growth should either be on par with or greater than the national average. And some of the things we look at is organic growth, for example, you know, than the mortality rates in the area. You know, typically expanding families will require a 2-bedroom apartment, maybe as opposed to the 1-bedroom. Next thing we look at is net positive migration. So are more people moving into that area versus moving area? Another thing we look at is immigration rates. So are people moving in from another country into the market? And, you know, I might be asking, like, why is this important? Well, it's actually, there's an interesting study that shows that about 60% of immigrants actually tend to rent for at least the first generation. So that's an interesting statistic to look at. Another thing we look at is income growth, right? So this usually leads to more reliable rent payments. And then lastly, we look at, you know, which markets have the large corporations where they've established. For example, our last property we just closed in June. You know, they have a headquarters of Walmart, JB Hunt, and Tyson. And, you know, basically they're expanding, they're always growing. And so we know that there's always going to be a constant demand for housing. And we always want to be where there's high demand and low supply, right? So, yeah.
Nice. Love it. I love it. Guys, I see we have a bunch of questions coming through. We're going to save some of those towards the end, right? We're going to have a Q&A to end, so we'll answer those as we come through. Some of them might be answered as we go through our presentation.
All right. So how do we source the deal? There's three different ways that we focus on. So number one is directly from brokers. So we've developed relationships with brokers through time. What do brokers want to see? I mean, brokers want to see that you've closed the deal. They want to see that you've been able to, successfully raise for a property that's $14 million. And once you've been able to do that, you can get on something called a priority list. So when that next deal comes up, guess what? We might not have to call the broker. They're probably going to be calling us. So that's one of the things we focus on. The next thing is direct or motivated landlords. What does this mean? So maybe mom and pop ran places. Maybe it was an inherited property. So we have a team that's going to call and say, hey, you interested in selling? And maybe it's just a distressed, non-institutionalized mom and pop running a place. And they're like, you know what? Thank God you called, because yes, we're selling. So anyway, and these are usually great because they're usually poorly run, undermanaged, and we just come and implement our value add business plan. Those are fun.
Yeah.
The last one is important. So this is our deal partners, right? So we give highest priority to our partners. And why is that? Well, we're actually part of, a private real estate investment group, which, these are proven professional capital firms who, they have their vetting processes. They've done their due diligence. They've done their underwriting. And why is that special? When we get a deal from them or they want to partner with us, it's because, well, we're going to do our own due diligence on this property, right? So now you've had multiple people look at these deals, underwrite it, and see if it fits our criteria. And these properties are usually rock star properties.
Oh, love it. I love it. I love it. And this is the example. Why don't you tell us a little more about our deal partners here?
Yeah, I mean, so you can see here, we have these deal partners here. They've done multiple deals. Why is it important? Because they've done multiple deals that have gone full cycle. So they've bought the property from day one. They've successfully implemented a value add strategy, and then they've exited. So they've exited and they've been able to achieve, you can see here, deal partner 3, 34% return to investors. Yeah. I mean, this is amazing, right? So
yeah, they are rock stars. I'm invested in some of their properties as well too. Those guys are amazing, right? And so I love it. Yep.
All right.
Yeah. So as Ritesh mentioned, what we do is we network within our private multifamily real estate environment, right? And we talk to all those deal partners who are putting together opportunities, are going out and doing the sourcing, doing the underwriting, which we'll talk about in a second. And we build the relationships with them, right? We get to a friend level with them. That way we understand who they are, what they do, what their process is, what their past performance are, good or bad, because you're going to have some bad properties, right? Like one of the properties I'm in, they didn't get the right information from the seller, right? And so they had to take a little bit more time to go do that. And that's going to happen. There are going to be, it's not everything is butterflies and sunshines and rainbows, right? So you do realize that there are issues, but when we do that, we know our team members will tackle those issues and do what's best for our investors, right? And that's the best thing about it. And they are successful, which is going to make us successful, which is going to make you successful, right?
So being a pro at risk mitigation is key.
Exactly, 100%. Yeah. That was what leads down to how we underwrite our properties, right? If the term underwriting, right, means that how are we going to determine our value of this property, right? And if it's what the seller is saying they have, right, what the seller is saying they can do, and what is our strategies to make sure that when we buy this property, we've gone through every scenario to understand what the situation is, what is our different quotes for insurance are going to be, what our property management costs are going to be, what our construction costs are going to be for our CapEx projects, right? All those things in nature. Is what our potential gains and returns are going to be on that. We model out different levels of debt structure. All of our properties have a level of debt, right? And that's really from an institutional firm like a Fannie or Freddie that's going to provide us that debt, right? And we model out different ways for that, right? I was on a call the other day where they went through 15 different types of debt modeling, right? To understand what's going to happen, what the capital stack looks like, right? And how that's going to affect the outcome of the property in this volatile market we're in right now, right? So there's tons of different ways, and our teams are, when I say they're vetted, they are vetted when they underwrite their properties. And it's not just one property they're underwriting a week. They're underwriting close to 30 to 50 properties a week. And I think the one team said that in the 4 years they've been doing this, they've underwritten 9,000 properties, right? And now, not every one of those is going through the full underwriting process, right? They have a quick process and it drops it down and keeps funneling it down to where then they get to the teams and the properties that they really want to go after and really want to dive for. Our minimum criteria after we do model out and after we do underwrite these properties is a 9% on average cash on cash return, right? That's that money, that passive income that you're going to get when you invest in a property, right? That's what's going to come to you after we get the property stabilized over a 3 to 5 year period, right? You're going to get an average of 9% cash on cash annually, right? And typically our structures are preferred to our investors, right? With a minimum of 8% pref to them, right? But we're always going to say 9% cash on cash. Our DCSR, or debt service coverage ratio, we like to look at about 1.4 as a minimum. Anything lower than that is not going to give the returns we want to get. Anything greater than that, then it's game on, right? Our average annual returns of 20% or better. The typical number we see, right, for these properties are anywhere between 18 to 22%, right? That's an average annual return over the lifespan of the property, right? If we're holding that property for 5 years and you're making 20% on that money you invested over a 5-year period per year, do the math, folks. That's pretty freaking awesome, right? And what that does is also provides us with a minimum equity multiplier. So what that means is after we sell or dispose of this property, right, when we exit the property, whether it's a sale or a refinance to get our money out and pass our capital back to our investors, that money or that investment is a 2x multiplier. So anywhere between 1.9 to 2.34 is a good investment, right? So Ritesh is going to kind of
that means you're doubling your money every 5 years, right? So if you
That's
put
right.
in $100,000 today, in 5 years you're going to get 200. You're going to have $200,000, and you roll it back into another investment. Then at the end of the 5 years, with a 2x multiplier, you're going to have now 400,000. Right? Isn't that phenomenal?
That's right. I mean, imagine if you let that money roll for 20 years, right? You're up close to $1 million, right? And that's just off of your initial $100,000 investment, or more than $1 million, obviously, right? And that's amazing, right? And plus, you're getting all the cash flow, you're getting all the depreciation of the tax. I mean, just
all the tax benefits and all that, right?
everything. So this is an example, right, of one of, and I know it's kind of hard to see, so you might want to kind of lean into your screen a little bit. We try to make it as big as possible, but this is an actual example from the property we closed that we're general partners on in June, right? And this is how they do it. The actual column is the first one. That's what the people gave us, right? That's what the sellers gave us. That was our T3 and T12. What that means is a trailing 3-month expense and income statement, or a trailing 12 expense and income statement, right? We take those numbers, plug it in, and it pops out what they expect to see, or what they are telling us they see. And then we estimate and we do our best. This is when we underwrite. We look at all of what we can do during the CapEx of the properties, what the loss for lease is, right? We want to obviously lower that loss for lease. If there's a big loss for lease on a property, which means that they've got 80% occupancy, 20% of the units are not occupied. Wow, that's big for us. That gets me excited, right? Because I know we're going to easily increase that and get that baby up to a 95% once it's fully up and running. And usually takes about 6 to 12 months, right, to get that property up and running and stabilized after we do our construction and get our people in there. So by 12 to 18 months, that property is humming, right? It's humming and it's earning cash flow. So you take your net operating income, which is your gross 1.6 million for year one, for example, minus all of your expenses, all right, $700,000, and your net operating income is $843,000. And you can see that number grows every single year to 1.2 million, right? That's how you get your returns. At the bottom, you see the first year you're getting about a 4.8% return. Next year bumps up to 8 because we've stabilized the property in year 2. In year 3, it's just rolling, right? And then we look at, sometimes in year 3, we look at a property and say, hey, you know what? It's too good to be true. This property is killing it, right? Our net operating income is really good. The cap rates are where they need to be. Let's sell the property in year 3 and just get all of our money back to our investors and move on to the next property, right? That's something we've done in the past, or our team has done in the past as well. Typically, we budgeted out for 5 years on this one. This one's a 5-year hold. So we're looking at it, and you can see down below, there's interest-only loan for 5 years. And then after that, P&I comes into place, which is when we're trying to dispose the property so we don't have to worry about. And that one, Claudio and Ritesh, that one was a 5.8 fixed fixed rate for 5-year interest only or something, right?
That is
5 year.
correct. That is correct.
Yeah.
That is a nice institutional debt, which is we can get financing at a lower interest rate that you all can. And
Yeah.
so that was a sweet interest only loan for the
Yeah.
first 5 years
A
of
lot.
the deal. And
Exactly.
to answer one of the questions, which typically, what is the time frame that we own one of these deals before we sell? Typically 5 to 7 years, right? Now that was going to depend on some particulars of the property, the market, and some other factors. But that is overall the strategy, the whole strategy that we have, 5 to 7 years.
Yeah. And there's been properties that have disposed of that have exited in 3 years too. Again, everything depends on the market, way it sits, what our structure is, how we're going to underwrite that property, where it's going to look at in 3 to 5, 7 years, right? That's our whole. So Joe asked that question, answered, great answer, Claudio.
I just wanted to add to that. So I think, another interesting thing about, we talked about how, to double your money and keep it moving basically, but depending on market conditions and things of that nature, maybe even a cash out refi in the right market, right, is another way to keep your equity within the property, continues to cash flow, right? You still own the property, but now you have this cash out refi. So you have this money, you have this cash that's liquid that you're able to now throw into another deal, right? And then you've basically accelerated your time frame of when you're going to reach that goal. So
I love it. And again, that is a great strategy for getting your initial capital back after that refi, keeping your equity in, and continuing to earn dividends or continuing to earn cash flow on your equity, right?
That's right.
As an equity owner in these properties, right?
All right.
All right. So asset management, we touched on all of these little buttons here before, right? In this entire property, but I don't want to just walk over this slide, Ritesh, because asset management is so important. So what does that mean? Well, after we close the property, right? After we buy the property, everything is good. We're now the owners of it, right? Valorous Capital Partners now owns that property. What do we do next? Well, our asset management team, right, which is, again, that professional team that we are partnered, we are linked arms with, right, all through that deal process. They are the ones, and us as well, will help manage that property, right? So we're going to go do that initial due diligence prior, so that asset manager knows that property, right? They're going to be the ones to hire the professional property managers and manage those managers, right? To make sure they understand, hey, here's our expectations. This is what we need to do. Make sure that we're getting the best deal and make sure they're collecting all the money for that. Also, they're going to manage the capital expenditure projects, right? So all the rehab, all the construction, anything that goes on in that property, the asset management team, their sole job is to manage that property and make sure our business plan goes from the beginning to exit, right? In a very seamless, smooth process, right? And that is because that's why we do the forced appreciation, as I mentioned. Again, why I'm so excited about it, because of forced appreciation, right? So I don't want to discount it, but asset management team they're the rock stars, right? They're the ones who take the property and make it where we can get the best returns for everybody involved, right?
And they is Claudio. So
they is Claudio and his team. That's right. Claudio's been to how many properties doing due diligence? He's been to too many properties doing due diligence and so forth, right? So
I live in a suitcase. Yes,
that's his bread and butter.
Yeah, so part of our team that does that asset management, Robin and I, we're part of the team that does that and make sure that we protect the asset, right?
That's right.
That's right.
Let's get into how to invest, or ways to invest actually. So go back one slide, I think.
Yeah, sorry, I hit the wrong button.
Yeah, so these are 4 ways that you can invest. So number 1 is liquidity, right? So if you just have money sitting in a savings account, maybe it's earning less than a percentage point. But Jeff and I talk about this a lot, is, in inflationary time periods, what is that? Less than 1%. It's actually like a negative percentage, right? So you're losing money. So liquid cash is one way. The second way is a self-directed IRA. Perhaps you have an old 401k with an old employer that isn't doing much. It's just kind of collecting dust, and you can actually invest in a real asset by converting this into a self-directed IRA or a solo 401k. I know a lot of my investors did know this before, but you can actually invest in a hard asset like real estate through the self-directed IRAs and solo 401ks. I'm going to save whole life insurance policy for last because I'm going to actually let Jeff talk about that one. But then last one here is HELOC. So that's a home equity line of credit from your primary residence. Let's say you bought a property and it's just appreciated in value. Maybe you have 100K, 200K, 300K in equity. Well, you can get a HELOC, home equity line of credit. I know the interest rates are a little bit high right now. I think they're going for about 7%. They used to be, a lot lower, but this is another way you can actually what we call leverage an interest rate, right? So you might borrow at 7%, but if you can put that into a property that can give you at least 20% AAR, right? So annual rate of return, you still kind of come out ahead there. So Jeff, I'd love for you to talk about life insurance.
Yeah. So I love this slide, right, on ways to invest for Tesh, because I do every single one of those. All four of these things on this, I am investing in real estate today with, right? So obviously liquid cash, right, for my private money, and also for the properties I'm in. I've got a self-directed IRA. So if you have questions on that, we can chat. Hit me up later. We'll set up a call and talk about ways to get your old 401ks, which are now IRAs, out of those markets and into a self-directed IRA. And I'll tell you who I use. Again, I'm not getting paid for it, but I love just getting people more interested. In fact, my buddy Sean, who's on here, has got me into it, right? So maybe you talk to Sean as well too. And then the whole life insurance policy, right? So if you haven't heard the term be your own banker, right, or infinite banking, right, that is derived from a specially designed and engineered whole life insurance policy. And what you do is you upload a lot of money into that policy to put steroids basically into it in the beginning, right? And you can borrow against that policy's cash value, not the death benefit. You borrow against the cash value, right? So your money stays in the whole life insurance policy, and that's earning interest every single day, right? It's earning interest. And at the end of the year, you earn dividends as well. So you're earning anywhere 5 to 6%, whatever that insurance mutual life company is paying you, right? And from there, you take your money, right, and you invest it into real estate, right? And you invest it into an asset that's going to pay you money, right? So I'm doing the same thing. I took money out of my whole life insurance policy. I'm paying it back to myself, right? I'm paying myself back on a monthly basis, right? And I get charged at 5.18% interest rate on that money, all right? I send it out, right, to go work in the real estate, right? And I'm earning 10% of that money, and I'm netting 5%. So I'm netting 5% on that, plus I'm making the 6%. I mean, again, it's blowing my mind. In fact, Ritesh, we could probably we're going to have a whole nother webinar about.
We can have another webinar just about that, right?
I think so. Yeah.
Yeah. And I also do a HELOC too. So I got it all, right? Don't let your lazy cash sit in your house, right? Earning your minimum amounts of appreciation on a daily basis. Take that money out, put into something that's going to earn 20%.
You know what my banker told me the other day? He said, "Hey, you have some. We were working on opening up another a interest generating account." He said something to the tune of, aren't you tired of lending that money for free to the bank? Right? That's what you're doing. When you have money sitting there not making any interest, you're basically lending your money for free to the bank so they can make lots of money." So invest it.
The bank cycle is crazy. You put your money into the savings account. The bank is going to take that money. They're going to lend it to John. John's going to take that money and he's going to buy a house with it, right? And he's going to pay that mortgage back, and that mortgage is going to go right back to that bank, and that bank's going to take that money again and reinvest it again. They're going to make 20% off your money while you're making a measly 0.1% off of it. Or if you're lucky to put it in a money market,
if you're making anything,
maybe you're making 4.5% off it, but you're still, again, it's just lazy money. Anyway, I'll get off that topic, and let's talk about.
We definitely need another one on this topic.
Exactly. That one, right? Let's talk about how we invest, right? So Valoris Capital Partners, we have what's called a cash flow portal, right? Our portal is our investor portal, right? So we can send out a link to this at a later time, and you would create your account in this. You would review an offering, if we have an opportunity to talk about right now, an offering memorandum, or OM, it's called in business, right? It's the property's PowerPoint presentation on what the property does, where it's at, what all the underwriting capabilities we've gone through all that market research to know what that property does. And we give you the nuts and bolts. What is the investment and how are you going to make money off that, right? And then once you review that, you love the deal, you sign what's called a PPM, or a private placement memorandum. And that is an SEC regulated document, right? We filed that with the SEC, right? It is a regulated document, right? So that is the Bible of the property. It spells out everything of who gets paid, when they get paid, how they get paid, who's the general partnership, who are the limited partners, or not really who are limited partners, but obviously you're a limited partner signing it, but who are the general partners and who they are. It tells you who gets paid, how you get paid. It tells you about every risk under the sun, right? An earthquake can hit in New Jersey, and that could be your problem. You could take care of it, right? It's going to tell you all that stuff, right? So basically, you sign that document, and then you fund your investment, and we're off to the races. That dashboard you see there is the actual dashboard. It'll show you your investment, it'll show you your property, it'll show your distributions, and it'll keep on rolling with you as you keep on growing your investment with us.
And in one of the investments, pardon, Jeff, there's a question about how many limited investors can you have in a single deal? And it really depends, right? We've seen hundreds, but there might be a pretty large deal, right? Where, you could have literally thousands of investors. That's, you're going to get distributions based on the amount of money that you invest. So, we could have 5 investors, say we're raising $5 million. We could have 5 investors, each puts $1 million, or we could have 500, right? It really all depends on the particular deal and how much money we're looking to raise for that particular deal.
And to add to that, typically it's a first fund, first served. So once we have an offering, it's, whoever jumps on first that's it. So if Claudio decides that he wants to put up the whole 5 million, and then, that's that. And the raise is over. But anyway,
I saw another question there too, is like, what's the minimum investment? So typically our minimum investment for these properties are $50,000, right? So you put 50,000 in. If you, like Claudia mentioned, you have 5 million right in there, 50,000 divided by that, right? You've got 100, I don't know the math, is that 100 investors, right? But typically you're going to have less than that, right? And that is based on your money you put in, is based on your structure if you get paid out. Now let's talk about what that looks like, right? An example, right, of what your payout structure. All right, sorry. Let's talk about during the investment. Sorry, I jumped the gun, Ritesh. This is your
okay
spot. Yeah.
No, I mean, it's important that they know, what to expect throughout and during your investment process, right? So we have something called investor relations outreach and updates. So, we want to ensure that there's clear, frequent communication with our investors. So they always know how the property is performing. We like to send out, monthly newsletters. This is going to be showcasing our capital expenditure projects. Was the pool renovated like you guys said you're going to do? How are the average rents looking? Did we increase them? What about vacancies? We were at 93% vacancy. What about this month? So yeah, these are things that we would love for you guys to stay updated. Even though you're passive, I mean, we want you guys to be as active as you like. And that's the beauty of this, right? So then we're going to keep going. So aside from that, we also believe, our investors should never be saying, how is this property performing? That's why these are important to do for us.
Yeah.
We also schedule quarterly cash flow distributions. This is the mailbox money that Jeff talked about before, the exciting part of it. And you'll also get a K-1 tax document yearly. Of course, we have to talk about liquidating the asset. So part of the hold period is liquidating the asset. This is where we sell the property. Investors get the return of their capital, any equity appreciation, as well as preferred returns catch up if needed. So, I think we've said this term a couple of times, but what exactly is a preferred return? Basically, we structure our deals so that our passive investors are paid their agreed upon preferred return, whether it's 7%, 8%, whatever we decide as before the property, we decide. So as general partners, we like to give our limited partners the preferred return first before we take any profit. And if for any reason, for any quarter that your pref wasn't met, well, when we liquidate the property, we catch you up on that pref return. And then you still get your equity appreciation after that. It's called a waterfall split. So yeah.
Love it. I love it. And that kind of leads into one of the questions we had. I know we got a Q&A here second in a bit, but I feel like I want to answer this question now. Ben asked, can you tell us a few examples of exit strategies? Are there multifamily properties that are taxed the same as single family for capital gains if you sell them down the line? So that kind of goes into the tax strategies, right? And so forth. But when you sell a property, right, there's going to be different ways to sell it, right? You either sell the property, right, or you refinance it, right? And from there, the single family properties are, there's a tax strategy called 1031 exchange. So a lot of times what we do is we'll put this money into a 1031 exchange, right? And you'll defer your taxes, right, down the line, right? So you can take your equity, your net money you've made, and you can defer it and put it into a 1031 exchange into the next property, right? And that's a way that all the real estate professionals can defer taxes to the end of that cycle, right? Keep pushing them down the road.
Right. So I would certainly would say it's very specific though to your own situation. So that's where you would want to consult with your tax advisor and figure out for your particular situation how does that work.
Gotcha,
specifically. Yeah. But in terms of our property, right? In the way that we do it with the cost segregation studies that we do, we are able to defer a lot of those taxes all the way to the end when we liquidate the property. And at that point, depending on your situation, you might be in a very advantageous tax situation as well. And and you're probably going to reinvest that money, some of that money, or all that money, or more money into another investment.
I love it. So here's an example of a actual property that we closed, and this is a 5-year pro forma. Let's say you were to invest $100,000. The market cap rate at the time is 6%. You can see here, this is a property that closed in the middle of the year. So the first year you get about half of that pref return, or the half of the cash on cash, which is predicted to be 9%. And then as you could see through year 5, you end up totaling a total of $45,256 of just cash flow. Equity at the sale is $81,518. So you get your initial return on investment, so the $100K that you invested, plus those two amounts, and then that totals $226,763. So that's about a 2.26 equity multiple. I mean, how do you feel about that, Jeff?
I love that. I love it. And the fact that there is an 8% preferred on that, 8% pref on that one, is amazing. And that, like we mentioned earlier, that year one, right, 4.8.6%. That's actually that rivals a money market account right now, right? So, which is the highest thing you can do without putting your money into an investment. And that's while during the capital expenditure projects, right? That's what we're doing. We're getting that property stabilized. And then year 2, you see those returns double, right? And then you keep increasing and average out to about 9% over the time frame.
That's right. Yep.
Claudia, you want to add anything on that one?
No, man. So that sounds phenomenal. I would just love to be able to bring that up to $500,000 and see how that it's a very impactful amount. And to everyone is different. I would one thing I would say is figure out how much cash, how much you want in yearly distributions, and that should tell you how much money you should have invested, right? So if your magic number is you want to get about $100,000 in cash distributions, then you will have to invest X amount of dollars in order for you to do that. And that's when you were able to retire, right? If you're able to put all that money to work for you passively. So this is one of the great ways in which you can do that, right? Whatever money you have access to, make it work for you.
Nice. Love it. I love it.
So you do have any questions that are unanswered in the chat here?
I think we do. Yeah. Okay. Well, let's just, before we get to there, let's say thank you, guys. Thank you so much for coming onto our presentation, right? Our first one. Hopefully we did good. If we did good, give us a thumbs up in the chat. But thank you so much for your time. We're gonna roll through here a couple questions. Let's see. So
there's one here by Patrick. So if you decide to refi to pay back investors, do the investors stay on to share the equity distribution when you exit? So the answer to that question is yes. So typically, if we do a cash out refi, you're able to keep your equity appreciation, your equity in the property. But I have seen
an example. Sorry, go ahead.
Yeah. No, I was going to say I have seen some capital firms not offer that, but so it's case by case. But go ahead, Jeff.
Right. Yeah. And an example of that, right? So let's say we get into a position now where we've got our fixed rate debt, right? And we're going through our value add strategy. And we say that in 5 years, right, it's not the right time to sell for some reason, right? Maybe the better thing is to refinance out because the rates are getting better, but the cap rates still aren't there yet, or vice versa. Well, we can refinance out of that property, get your equity back, or get your investment back, right? And then your equity stays in there. And then let's say we might hold that property for 10 years, right? And then you're going to continually get cash flow on that property. And then when we exit after that property, after that 7 year or 10-year time frame, as an example, right? Then you get your equity after the sale of that property, right? So 100%. I mean, that's a beauty about it, right? And you see the most wealthy people are real estate owners, right? They own real estate and they hold them for a while. But this is also another strategy we do, right? Is this one. And that, I love that question because that might be something for our generational fund that we're going to create here in the next year or so, right? Is properties that are going to stay with our team and stay in that fund for 10 years, right? And just continue just to grow and grow, right? Whether it's a multifamily property, maybe we can put some storage units in there, right? Or even some mobile home parks. I mean, mobile home parks are probably one of the best cash flowing vehicles out there, right? It's crazy to think about, but they are. And again, that's another question for another presentation. Let's see. Do we have any more questions out here, guys?
So I see another one from Nikki. Hey, Nikki. So any upcoming investment opportunities? So yes, the answer to that is yes. So we're basically always underwriting. And as we mentioned before, you know, we want the right deal. Has there been opportunities? Yeah. In fact, we've gone actually in under contract for one. And once we got to the property on that due diligence, it just didn't work out. And so we had to step away. But here's the thing. We're coming up on really exciting times. We touched on the market a little bit, but you know, we have to look back to 2020, 2021. There's a lot of operators who got into these low interest rate bridge debt loans who are coming up on expiration now, right at the end of 2023. And these owners are, unfortunately, they're going to struggle and they're going to have to sell, right? So we're really excited about the time that's coming up, especially at the end of this year, the beginning of next year. There's going to be a lot of opportunity to pick up some properties at really good discounts. And I think Jeff, Claudia, myself, we're really excited for this. We're really just primed in a position to, take advantage of this. And we would love for all of you to benefit from that as well.
That's right. Exactly. I mean, it's
excellent question.
It's going to happen. I've seen some graphs, and we can even share some graphs with our friends as well too on the call. But that show you that the amount of properties that are coming up, the debt coming up, that in early 24, right, that they might not be able to afford anymore, and they're going to have to dispose of those properties at a fire sale, and we're going to be able to pick them up and then obviously underwrite them correctly, right? So guys, how can we help you, right? That is we did this, right, because we are, we want to show you guys that this is what we're super excited about, right? There's opportunity out there for anybody, right? If you're interested in this, or you want to schedule a call with either three of us, one of us, or three of us, whatever you want to call, right? If you can scan that thing right there, it shows up, it's got a calendar invite, right? You can click it, you can schedule it at your convenience, and we'll talk and we'll have a good call. If you don't want to talk today, but you want to talk tomorrow, right? Shoot us an email. You have our contact information, hopefully. You'll get a replay of this as well too. So everybody who was able to attend, I know we had probably a handful of people who weren't able to attend. A couple of my friends that said hey, I got some stuff going on tonight, but will there be a replay? Yes, there is going to be a replay. We're going to email out that replay after the presentation, maybe a few days later, a few days after this presentation, right? And you and your friends can watch it and rewatch it, or share it, post it and share it, right? One other thing that I don't know if we had on here, and we can send it out as well too when we send out our information, is our Facebook page. Please go to Google or look up Valoris Capital Partners on our Facebook page. You'll probably see a billion posts from this webinar previously, right? But please friend us on Facebook, LinkedIn, Twitter. I think we got TikTok. I don't know. Maybe we got TikTok, right? Well.
Instagram.
Instagram, not TikTok. Instagram, right? I don't like TikTok. We do Instagram anyway. So we got all the socials, right? So follow us at Valoris Capital Partners, or each one of us individually will get in touch with you or talk to you. But again, that's what I want to say. I want to say thank you so much to everybody for joining. Ritesh, Claudio, you want to chime in?
Yeah, likewise. Just want to say thanks for everybody. Thank you for your time. And we look forward to chatting in the future.
Sweet. Love it.
Awesome.
That's
Same
it.
thing.
All
Thank you very much. That's it. It's a wrap. Thank you, guys.
It's a wrap.
right.
Guys, we did it. Our first presentation. I love it.
Have a great night, everybody.
All right. Thanks, guys.
Yep.